The Psychology of Money, Timeless Lessons on Wealth, Greed, and Happiness. By Morgan Housel. This is a book summary. Money is everywhere. It affects all of us, and it confuses most of us. But what if I told you that doing well with money has very little to do with how smart you are, and everything to do with how you behave? Welcome to today's video, where we dive into The Psychology of Money by Morgan Housel, a book that isn't just about making money, but about understanding it, managing it, and, most importantly, your relationship with it. It's the one thing we're all chasing, but somehow it slips through our fingers faster than we can hold on. We spend our days working for it, worrying about it, and wondering if we'll ever have enough of it. And yet, for something so fundamental to our lives, our understanding of money is often shockingly shallow. Why do some people with modest salaries build millions in wealth, while others with six-figure incomes live paycheck to paycheck? Why do lottery winners and pro athletes so often end up broke, despite fortunes that most of us can only dream of? The truth is, how we handle money isn't about spreadsheets, stock picks, or financial formulas. It's about psychology. It's about our emotions, our past experiences, and the stories we tell ourselves about what money means. As Morgan Housel puts it, the gap between what we know about money and what we do with it is often a chasm. And the reason is simple. Money decisions aren't made in the head. They're made in the gut. Take, for example, the story of Ronald Reed, a janitor who quietly amassed over $8 million through decades of saving and investing. No financial pedigree, no insider tips, just simple, consistent behavior and a deep respect for the power of compounding. On the other hand, we have Richard Foscon, a Harvard-educated finance executive who, despite his expertise and connections, went bankrupt by living large and leveraging everything he had. One was patient, the other was greedy. And that made all the difference. In The Psychology of Money, Housel argues that doing well with money has little to do with intelligence and everything to do with behavior. He explores how fear, greed, ego, and even luck play outsized roles in our financial decisions, often sabotaging us in the process. Money, as Housel reveals, isn't a math problem. It's a behavioral one. We'll explore some of the book's most powerful lessons today, like why time is more important than timing, why saving is more powerful than investing, and why the most important financial skill isn't picking stocks, but knowing when to stop. We'll talk about the seduction of pessimism, the illusion of control, and the deadly trap of just a little bit more. So, if you've ever wondered why you can't seem to save enough, why the stock market feels like a rigged game, or why those with far less intelligence often seem to do far better financially, then stick around. This isn't just a video about money, it's a video about you, your fears, your dreams, and the unseen forces that drive your decisions every single day. Segment 1, The Tale of Two Men. To kick things off, let me tell you a story about two men. The first is Ronald Reed. Now, Ronald wasn't anyone you'd look at twice if you passed him on the street. He wore flannel shirts, drove a used Toyota Yaris, and spent decades working as a janitor and a gas station attendant. No fancy suits, no financial pedigree, and certainly no appearances on CNBC. He was the kind of guy who'd walk into a diner, order the $2 breakfast special, and leave a modest tip. But Ronald had a secret, a quiet obsession that no one knew about. For years, Ronald saved whatever little he could. Instead of new clothes or fancy gadgets, he bought shares of reliable blue-chip stocks, companies like Procter & Gamble, Johnson & Johnson, and JP Morgan Chase. No high-risk bets, no day trading, just slow and steady investments in businesses he believed would stand the test of time. And he never touched his portfolio. Through recessions, booms, and busts, Ronald did the hardest thing of all: nothing. By the time he passed away at the age of 92, Ronald Reed stunned the world by leaving behind more than $8 million. The man who spent his days sweeping floors ended up donating millions to his local hospital and library. No fancy degrees, no Wall Street connections, just patience, consistency, and the magic of compounding. Now meet Richard Foscon, Richard was the opposite of Ronald in almost every way. A Harvard MBA, a top executive at Merrill Lynch, and a man who made millions before most of us had our first real job. Richard's life was a highlight reel of high finance, private jets, sprawling mansions, and a lifestyle that screamed success. In the 90s, he was so confident in his financial acumen that he retired in his 40s to focus on philanthropy, comfortably living off his investments and properties. But Richard's life was built on leverage, debt stacked upon debt, all under the assumption that the good times would never end. He borrowed heavily to expand his 18,000 square foot mansion in Greenwich, Connecticut, a palace with 2 elevators, 7 garages, and a monthly upkeep of over $90,000. But then came 2008, the year that shredded the balance sheets of even the smartest financial minds. As the financial crisis unfolded, Richard's empire collapsed like a house of cards. His assets were illiquid, his debts were massive, and his income had evaporated. First, his Palm Beach house was foreclosed, then his Connecticut mansion. By the end, Richard Fuscone was bankrupt, admitting in court that he had no income. How could a janitor with no financial education outperform a Harvard-educated finance executive? The answer lies at the heart of Morgan Housel's The Psychology of Money. Financial success isn't about IQ, it's about behavior. Ronald Read understood the power of compounding and the importance of patience. He didn't need to be a genius to know that planting a seed and giving it decades to grow was more powerful than trying to strike it rich overnight. Richard, on the other hand, lived as if the good times would never end, leveraging everything, saving nothing, and underestimating the risk that came with all that borrowed money. Housel argues that the real danger isn't not knowing enough, it's thinking you know everything. Richard believed he could manage any risk because, well, he was Richard Fuscone, a Harvard MBA, a Wall Street legend. Ronald, however, was humble enough to know what he didn't know. He trusted in time and the magic of compounding, allowing modest savings to snowball over decades. It's a reminder that money isn't just about getting wealthy, it's about staying wealthy. And sometimes the tortoise really does beat the hare. These two men, one a janitor, the other a finance executive, are proof that wealth is about behavior, not brilliance. It's about humility, patience, and a deep understanding of what Housel calls the hardest financial skill of all: getting the goalpost to stop moving. The question isn't how much money you make, it's how much you keep. So if you think managing money is all about stock picks, market timing, or the perfect strategy, think again. As Ronald Read showed us, true wealth is quiet, patient, and surprisingly simple. Managing money is less about what you know and more about how you think. It's about resisting the urge to sell in a panic when markets plummet, ignoring the seductive lure of quick profits, and, most importantly, having the humility to admit what you don't know. Ronald Read understood this on an almost instinctive level. He wasn't trying to outsmart the market or impress anyone. He wasn't chasing the next big thing or making high-risk bets. Instead, he practiced the most underrated financial strategy of all: consistency. Investing modestly and regularly, avoiding debt, and letting the quiet power of compounding do the heavy lifting. Ronald's story is proof that financial success is less about spreadsheets and more about self-control. Meanwhile, Richard Fuscone, with all his education and connections, was ensnared by a different enemy: ego. With multiple mansions, a lifestyle that cost nearly $100,000 a month to maintain, and a belief that the good times would never end, he leveraged everything, betting big with borrowed money. He confused being rich with staying rich, a mistake that proved disastrous when the tide turned in 2008. In Housel's words, the difference between getting wealthy and staying wealthy is simple: humility. Knowing that you can be wrong, that markets can turn, and that no one, no matter how smart, is invincible. Segment 2: Luck, Risk, and the power of time. Let's talk about two powerful forces that can change everything: luck and risk. Housel calls them siblings, two sides of the same coin, both beyond our control yet shaping our financial fates in ways we often fail to appreciate. Consider Bill Gates. We all know him as the co-founder of Microsoft, a billionaire genius who changed the world with software. But what if I told you that Gates' success wasn't just a product of his intelligence or even his work ethic? In 1968, Gates attended Lakeside School, one of the only high schools in the world that had a computer. In fact, out of the 33 million high school-age kids in the world at that time, only about 300 had access to a computer like Gates did. Without that one-in-a-million stroke of luck, the story of Microsoft might never have been written. And then there's Kent Evans, Gates' best friend and equal in every way. Kent shared Gates' intelligence, ambition, and even his obsession with computers. Together, they dreamed of building a company that would change the world. But life had other plans. In a tragic mountaineering accident, Kent's story ended before it even began. Luck put Gates on a path to a trillion-dollar company. Risk took Kent off that path forever. The lesson is clear. You can't have luck without risk. For every Bill Gates, there's a Kent Evans. Someone who was just as talented but ended up on the other side of the coin flip. This is why Housel argues that humility should be at the core of any financial strategy. Acknowledge the role of luck in your successes, but also respect the power of risk in your failures. But here's the real secret sauce: time. If luck and risk are the forces that nudge us forward or pull us back, time is the multiplier that determines how far we go. No one embodies this truth better than Warren Buffett. Housel illustrates this with a powerful thought experiment. Imagine if Buffett had started investing at 30 instead of 10 and retired at 60 instead of still investing at 90. His net worth wouldn't be $84 billion, it would be just $11.9 million. Still impressive, sure, but it's a mere fraction of what it became thanks to compounding. The lesson is simple yet profound. It's not about earning the highest return. It's about earning pretty good returns for the longest period of time. Time transforms modest savings into millions, but it also magnifies mistakes. The longer you stay in the game, the greater the chances of facing a market crash, a financial crisis, or a personal setback. That's why Housel argues that the most underrated financial skill isn't picking the right stock, but simply surviving. You can't compound if you're not still standing. It's why Ronald Reed, the janitor who never earned more than $12 an hour, could build an $8 million fortune. He played the long game, avoided debt, and let compounding do the work. Meanwhile, Richard Fuscone, the Wall Street executive, played a short-term game, betting big with borrowed money. When the crash came, it wiped him out because he hadn't built any margin for error. In the end, financial success isn't about IQ, degrees, or even luck alone. It's about patience, humility, and staying in the game long enough for compounding to work its magic. Housel's message is clear. Wealth is what you don't see: the savings, the patience, the decisions not to buy that bigger house or take on more debt. It's the quiet power of letting time work for you, instead of trying to outsmart the market. So if you want to build wealth, don't just think about how to make more money, think about how to keep it, how to survive, and how to play the long game. Because in the end, the real secret to wealth is simple: don't quit the game. Segment 3, freedom, happiness, and the trap of more. So, what's money really for? According to Housel, it's about freedom, the ability to wake up and do what you want, when you want, with whom you want. It's about reclaiming time, the most valuable currency we have. But here's the problem. Most people don't stop once they've secured that freedom. They fall into a trap, a relentless pursuit of more. More money, bigger houses, faster cars, and in chasing more, they risk losing the very freedom they're working so hard to attain. Housel tells the story of Rajat Gupta, a man who embodied the classic rags to riches tale. Orphaned as a teenager in Kolkata, Gupta climbed to the very top of the corporate ladder, becoming the CEO of McKinsey and amassing a fortune worth $100 million. For most of us, that kind of wealth would be more than enough. But for Gupta, it was just a stepping stone. He wanted to be a billionaire, to sit at the same tables as the private equity tycoons and Wall Street kings. The more he had, the more he wanted. And that's when everything unraveled. It starts small. First, it's just a nicer car, then a bigger house, then a private jet. For Gupta, it was insider information, just a tip to a hedge fund manager, a little nudge that would turn millions into more millions. 16 seconds after learning about Warren Buffett's $5 billion rescue investment in Goldman Sachs during the 2008 crisis, Gupta picked up the phone and made the call that would end his career. A few weeks later, he was in handcuffs, his reputation and freedom gone. In the pursuit of more, he lost everything. But Gupta's story isn't just about greed, it's about failing to define what enough means. Housel argues that if you can't draw that line, you'll spend your entire life moving the goalposts. And here's the thing, the goalposts don't move forward evenly. They sprint ahead. The faster you run, the faster they move. You upgrade to a bigger house, but then you need more money to furnish it, more time to maintain it, and suddenly, you're trapped in a cycle of working to afford a life you barely have time to live. It's what Housel calls the man in the car paradox. No one looks at someone driving a Ferrari and thinks, wow, that guy must be really smart and successful. Instead, they think, wow, I wish I could have a car like that. The admiration we think we're earning with wealth is really just people imagining themselves in our shoes. The problem is, by the time we get the Ferrari or the penthouse, we're already eyeing the next upgrade. The goalposts have moved again. Then there's the story of Bernie Madoff. Before he became infamous for orchestrating the largest Ponzi scheme in history, Madoff was already a wildly successful and legitimate market maker, earning tens of millions every year. But for Madoff, even that wasn't enough. The hunger for more led him to steal $65 billion, ruin thousands of lives, and die in prison. For Madoff, the line between legitimate success and criminal greed was erased by a simple thought, just a little bit more. Housel's advice is simple yet profound. Define what enough means to you. Because if you don't, you'll never stop moving the goalposts. Think about it. What's the point of wealth if it doesn't buy peace of mind, time with loved ones, or the freedom to say no? If your happiness is always waiting at the next milestone, you'll spend your life running without ever arriving. This brings us to one of the most powerful questions you can ask yourself. How much is enough? For Warren Buffett, the answer was clear. Despite his billions, he still lives in the modest Omaha house he bought in 1958. He drives a sensible car, drinks the same Coke every day, and avoids the lifestyle inflation that traps so many of the ultra-wealthy. His secret isn't just being a great investor, it's knowing when to stop chasing more. But defining enough isn't just about possessions, it's about time. It's about the freedom to do meaningful work, to spend afternoons with your kids, to take a walk in the middle of the day without checking your phone every 10 minutes. It's the ability to make decisions based on what you want, not what you need. As Housel puts it, the ultimate form of wealth is controlling your time. That's why Ronald Reid, the janitor who left behind $8 million, was wealthier in many ways than Richard Fuscone, the Wall Street executive who lost everything. Reid didn't spend his life trying to impress people or keep up with the Joneses. He defined enough early on and stuck to it. By avoiding debt, living simply, and letting compounding work its magic, he built a fortune in silence, one that wasn't measured in yachts or mansions but in financial freedom and peace of mind. So ask yourself, what does enough look like for you? Because if you don't answer that question, someone else will, your boss, society, or the endless ads, telling you that you'll only be happy with the next upgrade. And once that happens, you're no longer building wealth, you're just running on a treadmill. Housel's lesson is clear. More money won't solve money problems if the real issue is a lack of direction or the need to prove something. Because at the end of the day, wealth isn't about the money itself. It's about what the money allows you to do. So define your enough, slow down the chase, and start living. Because sometimes the richest man in the room isn't the one with the most money, it's the one who's free. Segment 4, the seduction of pessimism. Let's talk about a powerful force that influences how we deal with money: pessimism. As humans, we're wired to respond more strongly to bad news than good. It's a survival instinct that kept our ancestors alive when every rustle in the bushes could mean danger. But in today's financial world, that instinct can work against us. Negative headlines grab our attention like moths to a flame. Stock market crashes, housing bubbles, inflation fears. And the more we focus on what could go wrong, the more likely we are to make decisions driven by fear rather than reason. Housel argues that while pessimism sounds smart, after all, no one wants to look like a fool for ignoring risks. Optimism is the only stance that aligns with how progress actually happens over time. It's easy to see why. Pessimism demands action. Sell now, save yourself, prepare for the worst. Optimism, on the other hand, sounds naive. It requires patience, faith in the future, and the courage to do nothing when everything screams to do something. Think about it. Since 1900, the stock market has grown more than 10,000-fold. But during that time, it's also crashed by 30% or more on dozens of occasions. Wars, recessions, pandemics, and oil crises. Time and again, the headlines told us to run for the hills. Yet here we are. Markets recover because progress isn't a straight line, it's a jagged one. In the long term, optimism has always been right. As Housel puts it, the short term is a story of volatility, but the long term is a story of growth. Consider Andred, the janitor who quietly built an $8 million fortune by investing patiently in blue-chip stocks. During his lifetime, the market experienced multiple crashes: the Great Depression, Black Monday, the dot-com bubble, the 2008 financial crisis. Ronald's secret wasn't knowing when to sell, it was knowing when to sit tight. His optimism wasn't blind, it was disciplined. He knew that, historically, the market always recovers. And it did. But let's be real, staying optimistic is hard. Especially when pessimism not only sounds smarter, but also sells better. Headlines about a booming economy don't get clicks, doomsday predictions do. The next recession is coming will always get more attention than the market is fine. Housel argues that this is why we're so quick to panic, so slow to invest, and so often left on the sidelines, watching others grow wealthier simply by staying the course. Take 2008 for example. During the financial crisis, fear spread faster than the flu. Pessimism wasn't just popular, it was profitable. Pundits who predicted the collapse of everything from housing to currencies became media darlings. Many investors sold everything in a panic, locking in losses and missing out on the longest bull market in history that followed. Those who stayed invested, like Ronald Read, ended up wealthier than ever. Because, as Housel reminds us, optimism is the only realistic stance over the long term. Progress is slow, setbacks are sudden, but in the end, growth prevails. This isn't about ignoring risks, it's about recognizing that risk and opportunity are two sides of the same coin. For every crisis, there's a recovery. For every crash, a rebound. As Housel says, nothing is as good or as bad as it seems. During the Great Depression, when unemployment was at an all-time high and the future looked bleak, people still started businesses, bought stocks, and invested in their communities. And those who did, those who believed that tomorrow could be better, were the ones who built wealth in the end. So, the real challenge isn't predicting the next crisis. It's surviving it. It's building a financial plan that can withstand volatility, staying invested when it's uncomfortable, and resisting the urge to sell when fear is at its peak. Hausel's lesson is clear. Wealth isn't just about making money, it's about managing fear. Because if you can't master your emotions, you'll never master your finances. So, what's the ultimate lesson of the psychology of money? It's that wealth isn't about earning more. It's about managing what you have wisely. It's about humility, patience, and understanding that the most powerful force in finance isn't your income, it's your behavior. If we could sum up Housel's philosophy in one sentence, it might be this: don't try to predict the future. Prepare for it. Save more than you think you need. Invest with the patience of a gardener. And remember that wealth is what you don't see. The cash not spent, the risk not taken, the lifestyle not upgraded. So, if you enjoyed this breakdown and want more lessons from powerful books, don't forget to like, subscribe, and share your thoughts in the comments. And until next time, remember, it's not about how much money you make, it's about how you think about it.